Welcome to the Market Call podcast. This is Louis Llanes. Have you ever had somebody tell you you should diversify your portfolio based on a style box? You might have seen these funny grids that show large companies, mid-cap companies, value and growth, etc. That's called a style box. A lot of investment advisors tell you that somehow this is going to give you a magic ticket to help you diversify your portfolio better in stocks. In this podcast, I'm going to talk about a better way to do style boxes, a style box that's based on factors that actually tie better to performance in our research.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Today, I want to talk a little bit about style. One of the things that we've noticed is that many people have this view of style, kind of like a style box type of view of the world in the stock market. We look at style in a very different way at Wealthnet. We look at style from the perspective of how it is going to perform in different economic environments. And we also look for style that has a tendency to have a different correlation to each other because we're looking for the best diversification so we can lower our risk but keep that return number high. So I'm going to talk a little bit about some of the styles that we use in the equity market, and we've really developed these over years of experience and research, and we have multiple different styles, but today I'm going to talk about the four biggest ones that we see in the marketplace and how we slice and dice up the U.S. stock market. Now, if you have been following my research over the last 20 years, you know that I have always been using a concept of quality, valuation, and technical. So I split the market up by these characteristics of quality, meaning how knowable are the cash flows, how solid is the balance sheet, the basic quality of earnings, all of those types of factors that are wrapped up into one element. And then the valuation has to do with how much are we paying for that particular investment given its measures of value, like earnings and assets and cash flows and dividends, things like that. And then there's the technical side, which has to do with the supply and demand of the investment itself. Is the marketplace recognizing that particular opportunity? Now, when you look at the stock market in general, we have a massive quantitative system that we have developed over the years that allows us to look at all the stocks that are liquid and tradable in the United States. And we score them on various metrics. And within each one of those big components, quality, value, and technical, there are many sub-elements to it, meaning there's different metrics that we're looking at. And right now I'm talking just about quantitative information. That is the information that's just numbers. So we also obviously look at the qualitative side. It's a big part of what we do. But today I want to focus just on how we look at style and how it's so different than, say, some of the style box type features that you see with most kind of third-party data vendors. Hello, happy podcasters. This is Louis Llanes. Have you read my book, The Financial Freedom Blueprint? If you haven't, you should check it out. You could get a signed copy. I'm signing copies. You can go to pathtorealwealth.com and pick up your copy. Let me tell you just a few reasons why you should pick this book up. First of all, I put years of experience of advising individual investors of all types, very high net worth people, as well as people, just normal everyday people. And I explain to them the 7 steps to accelerate their path to prosperity, to keep their money, and to build the money. And I use some very specific techniques to help you drill down quickly to the most important factors that will help you make better financial choices. Pick up a copy today at pathtorealwealth.com. So the first thing I needed to define for you is that we look at these 3 dimensions, and within those 3 dimensions, we have degrees to which each company is demonstrating a high or low quality, value, or technical characteristic within its industry, within its sector, within the overall market. So that's the first step, is looking at those dimensions. Now, depending on each individual stock's kind of degree of quality, degree of value, degree of technical components, depending on that will also give us ways to blend those to find opportunities, because there's times in the markets, and I think you'll see here in just a minute, there's times in the markets when different styles, different blends of QVT do better. And when we diversify our portfolio among those styles of companies, and all of them are great companies, but when we diversify them among those, we get a better risk-adjusted return based on our research. Let's start off with the kind of the one that is kind of the one that everybody kind of thinks of, and that would be the quality on a roll. We call it quality on a roll. And basically what that means is we have a company that has very, very high quality, very strong balance sheet, very consistent earnings and cash flows, and their debt is, not too high, those types of things. So we have good quality from the metric standpoint. And we also have a situation where the stock itself is being recognized in the marketplace. So we have very strong technicals. Now, the key differentiation between the quality on a roll and another category, which I haven't talked about, is that the valuation is overvalued based on our metrics. So generally, the value is very, very excessively high. You could still make money in those companies, because when the markets are strong, these companies tend to lead, where the valuation is not super attractive by any stretch, but the quality of the company and its business itself is doing well, and the market is recognizing that particular stock. So that's quality on a roll. That would be an example of one of our styles. Another one would be quality at a reasonable price. So that's the same high quality, but the valuation is reasonable. It's not great, but it's reasonable. So we're paying a reasonable price for the earnings and cash flow and dividends, etc. So quality at a reasonable price, or QARP. Another one would be our rock stars. Our rock stars would be your stocks that have all three characteristics, quality, value, and technical, all hitting on the top quartiles, the top cylinders, right? So these are the types of companies where they meet all the criteria, right? The valuation is fairly good. The technicals are great. The quality is great. It's kind of, you don't see that many of them, but when they're there, sometimes they can be really good opportunities. And then the other would be we talked about quality at a reasonable price. We talked about quality on a roll. And the last one I'll talk about today is emerging value. So basically what that is that's a company that's quality is not necessarily the best, but it meets a threshold of to where we think that company can actually, they're not going to go out of business. They have an adequate amount of quality. It's not amazing, but it's an adequate amount. And the valuation is very attractive. A very attractive valuation. The quality is there. And the technicals are just now starting to improve. So that would be a company that has a lot of times they're not really as knowable. Like, you don't see them on the headlines. They're typically not headline type stocks. There's a ton of these companies out there right now, and I think as the economy strengthens, that's going to help these types of companies. So if you have a diversified portfolio of these, and this is the main point of this conversation today for us, just to communicate it as investors out there, instead of looking at large cap this, small cap that, value, growth, for us, we have found, based on the diversification of factors, that it's better for us to think of them in a little bit different way. You have companies that are on different points on the S-curve between being a newer company that's growing fast versus an older company going all the way to a mature company. And we want to be able to capture profits for our investors and for our own personal net worth by identifying what we would consider more true styles. So diversification of style is important because, most stocks are highly correlated. And even when you do style correlation like this, or style diversification like this, you're going to improve the diversification, but you still have relatively high correlation in the overall stock market. So diversification across broader asset classes for the total net worth of an individual's net worth is very, very important. But I wanted to point this out because there is this kind of way of categorizing out in the world, in our view, that doesn't make as much sense as how we would select a stock from a bottom-up perspective. It's convenient to use these other methods, but if you dissect the factors based on their performance and based on various elements of a stock and how they perform over time, we find that this way of looking at the world can be more attractive for investors. So anyhow, some ideas for you out there. So for investors who want to have a better approach, in our opinion, we like to look at these ways of looking at style. All right, if you guys have any questions or just reach out to us, be sure to subscribe to our YouTube channel. As always, Louis Llanos signing off. Have a great day.
For the latest episode of The Market Call Show, make sure to like, subscribe, and follow us on Facebook, Twitter, and YouTube. Go to marketcallshow.com for all our past episodes and sign up to get alerts for new episodes. If you enjoyed the content of this episode, please leave us a 5-star review and comments. The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Wealthnet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Wealthnet Investments and its representatives are properly licensed or exempt from licensure.